Welcome back. My name's Chris Gosselin from Australian Fund Monitors. Today, the Reserve Bank increased interest rates by 0.25%, having reduced them by 0.25% last August, and in fact had 3 rate cuts last August. We're joined, as we always are, talking about interest rates in the Reserve Bank by Nicholas Chaplin and Renny Ellis. Welcome, gentlemen. Good to see you. Happy New Year. Is it a Happy New Year for mortgage holders? Definitely not. Is it a Happy New Year for the Reserve Bank? Nick, fire away.
I don't think so. I think getting into today's move, I think once again, whilst it's very clear to me that they made a grave error in August dropping, and we made that very clear, so I won't go over that again. At least in this opening statement. But they've proven to me that they seem to be acting on very short-term information and without a broader lens of things, including things like the exchange rate doing policy work for them, particularly in the last month. We've seen it go back over 70 cents today. We'll talk about that. I think there's some financial conditions are tightening to some extent, can be argued. She talks about supply, but I think it's missing the point to a large extent. So, no, not a good day. Not a good day and not a good opening for the RBA in 2026.
Renny, Michelle Bullock made a point of saying when circumstances change, we change. Yet you haven't changed your view, or at least I don't believe you changed your view, that they shouldn't have cut last August.
No, at all. At all last year. The Reserve Bank never achieved a period of negative monetary growth. The ECB did, the Federal Reserve did in the United States. They can claim that they actually had some impact on lowering inflation. The RBA, the reduction in inflation became merely from the supply chains being restored after the pandemic. This was transitory inflation. To go back to it, it's a dirty word, but that's all that happened. Reserve Bank policy didn't have an impact on it last year. We did see slower growth when bank bill swap, 9-day bank bill swap was up around 440, 450. And I have said this in this forum before. It's important to remember that our economy, because of our extreme household debt to income ratios, our economy tends to stop still a little bit when rates get up to those sort of levels. So while there was an interest rate increase today, I don't know that we're going to get another one as quickly as some commentators are saying we will. It may not be until the end of the year. They may let this be a little bit slower on this one.
But you think there's another one coming?
I think that. And Nick wanted to talk about the exchange rate. I think the exchange rate being so strong does buy them, maybe a little bit of space because, on a trade-weighted basis, the exchange rate's up about 10% over the past year, maybe a little bit more after today. And we do import a lot of goods. So we may see, with a 90-day lag, the inventory cycle, we might see a softening of inflation into, April, May, a little bit, and they may be able to look at that and go, well, we've got a little bit more time. But I'm a firm believer that cost push inflation's underway. Nominal wages growth is too high. Labour productivity's now positive, but it was negative most of last year, and that there wasn't room to be cutting rates at all last year. We were operating well inside full employment last year. There was no need to cut rates last year. They needed to just sit still.
So was that done because of pressure from the Treasurer, from government?
We have an independent Reserve Bank, Chris. What are you talking about?
Renny, I'm a bit more cynical than you. Talking about the government, I noticed that Jim Chalmers was very quick to come out and say it's not his fault. But
do we still have an independent Federal Reserve in the United States? I would argue we do. And even if Walsh is appointed, Trump's favourite, because there were 10 votes against cutting rates at the last meeting, only 2 for cutting rates. In our Reserve Bank, maybe not as independent as the Federal Reserve.
So,
certainly
well,
argue
maybe
that.
they're just more inclined to be pressured by media and public opinion and Treasury.
I think they will say, and Michelle Bullock will say in the interview afterwards that, hey, we're independent, we have to remain independent, we have to just look at the data. But they're hearing left, right and centre from the media, particularly after the July meeting when they didn't drop and everyone expected that it would drop in July. They ultimately did it in August. Neither of those months, as we said, was warranted to have a drop in interest rates, but they did it. And it felt very clearly to me that they were reacting to pressure. I think in July they'd had the three more or less independent board members say we should be dropping, and the other 6 said no. And then in August it was unanimous. But it just felt that the pressure got to them, and it was unnecessary. I think the things that Renny and I were saying at the time were not unnatural things to say. They were based on fact. They were based on what we were seeing. My main concern is, and getting back to this question of lags, there's been an insufficient respect for policy lags. Things take longer to affect, and monetary policy changes take longer to affect. So if they were to raise again, for example, in March, if the media's out there saying there needs to be another one because look where the monthly CPI data's gone to, this is just craziness. And it completely unravels the logic that she was applying halfway through last year.
Presumably the media are listening to the big bank economists someday. I mean, the big bank economists, including the AMP, came out in August and said they're going to be 2 or 3 rate cuts in 2026.
The problem is,
now
though,
reverse that entirely. So maybe the media are just listening to the big banks.
Chris, could I just correct you there? Everybody but Nick and I were saying there were going to be the rate cuts. Everyone but Nick and I.
I agree with that. I'm the first person to give you major pats on the back for getting it right, but I can't quite understand.
It would be more entertaining if one of us had
why everyone else got it wrong.
It would be more entertaining, but I don't. Unlike the RBA, I'm not willing to go against logic just for the sake of entertainment. I think the issue is economists at the banks get it wrong all the time. They also occasionally get it right, and they'll just simply move on. And they get it wrong because no one's got a crystal ball, and you can't predict this and that and the other. But you've got to act as best on logic as you can. And right at the moment, I'm concerned. My view, and we, in the office here, we were suggesting earlier in the day, what are they going to do? Well, they shouldn't move. Everyone's saying they're going to move, but they really shouldn't, because you've had an 8% move, and not even looking at the TWI. The TWI is greater than the 8% raw move you've had in the AUD-USD exchange rate. But that is, this is a relatively sharp appreciation in the AUD over the past month, and that's a meaningful tightening. Hiking on top of this raises the risk of an overshoot, and you could get that, particularly for tradables, inflation and growth. So I think at the end of the day, the risk now is, apart from the fact that they've just revealed that they got it so horribly wrong in August. She didn't say that. I was really surprised no one brought up currency at all in the post, at least until we started this discussion. No one had brought it up.
Oh, well, Nick, there's a very limited understanding that the transmission mechanism of monetary policy into the economy, when you have a floating exchange rate, is via the currency.
Yeah.
That's the transmission mechanism. But so I agree with you. With a lag, we'll see lower inflation May thereabouts. How much lower, I'm not as sure about. I do expect that these inflation figures will end up pushing the unions and others to push for a stronger wages growth. But that with a lag, we won't see that coming into final prices until probably the September quarter. And that's why I say, maybe they will wait. And I was a bit on the fence as to whether they would increase at this meeting a little bit as well. But they may wait until September for the next increase.
Well, but based on past history, with all the banks now saying there's going to be 2 more rate rises this year, you're probably right. There won't be. I mean, their track record for getting it right. This is the big bank economists and the media is not that great. So you could take a reverse punt on that.
Chris, could I just point out here again that there's this misconception that we see out there about bond yields reacting to the interest rate, the RBA official interest rate decision. And I know I've said this before, but the RBA controls only the short end of the curve. The long end of the curve has been steepening over the past few months in anticipation of this inflation problem. We're now on our 10-year, we're now at a 60 basis point premium to the US 10-year. Now, we have been trading, the last few years in a 15 plus or minus range around the US 10-year. So I think the market, there is room for the yield curve to flatten here a bit, and particularly if they've got it wrong and do keep increasing rates quickly, we may well see the 5 to 10-year part of the curve yields fall in the 5 to 10-year part of the curve rather than keep rising while the short end keeps rising.
Is there an argument to say that the Reserve Bank's preferred band of 2 to 3% for inflation is unrealistic?
Yeah, I think you've always got that argument. And I've heard that argument before, that the RBA needs to, instead of raising rates and putting enormous pressure on tighter monetary policy and possibly ruining the economy, and this is the sort of extreme words that are used by people that suggest that the range needs to rise to 2.5 to 3.5 or 3 to 4. I think that would be a mistake personally. We're still in a situation of historically low interest rates, especially if you're looking, say, over the last 30 to 40 years, not going further back than that, but certainly since the 80s and 90s. Our interest rates at the moment are relatively low. I think the situation that we've got now is we're still coming off a reaction to the COVID crisis that started in 2020. So this is now into year 6 in terms of trying to fight something that was affecting the economy largely over the next 3 years from 2020 to 2023. So this has been the first rate rise now since November of 2023. Arguably, again, if you, in hindsight, and the reason I'm a little bit worked up about today is that you can always look and say, well, in hindsight, everything's 2020, but in this case, it was very clear that they were not looking at a whole bunch of other things. They say, oh, we look at unemployment and we look at CPI, and that's all we've got to actually look at. No, there's a whole lot of other indicators, including some of the things we were talking about, such as even in December, we were seeing some of the things that were driving inflation up for the monthly calculation, such as subsidies still coming off in December, from federal subsidies to state subsidies. We've mentioned that all before. But it was still happening, and that's what was reported in January's CPI number. So that was still going on. You had the FX impact we've talked about. I think there's actually a case now, rather than trying to chase the range of CPI to fit it to where CPI goes, which is a mistake, there needs to be a long, hard look at how the RBA is working. I think their credibility comes from a clear reaction function over time, not from frequent course corrections in response to short-term data. And that's all I've seen for the last 6 months.
Could I just add to that, Nick, that we also saw in the second half of last year, particularly, but even I mean, look, I would argue that the RBA had no business cutting rates in February last year ahead of an election where lots of spending was being promised when we were at a time of full employment. Don't get me wrong. February cut shouldn't have occurred. They should have held their firepower. We then saw, though, an increase in credit growth, both private credit growth, home lending growth, house prices started to increase over the year. That is a clear sign that monetary policy is accommodative, not restrictive, as they kept on claiming. You cannot be seeing private credit growth increasing and saying at the same time, oh, well, monetary policy is restrictive. It wasn't. And if I think that if we'd gone back then and we'd seen for whatever reason private credit growth started increasing, and it will have had a lot to do with government policy, then they shouldn't have been cutting at all last year. And then we look at a situation now where we wouldn't be having to increase rates now because we didn't cut them last year. I do think also, just quickly then, the currency breakout above 70 is a significant event. We're going to be talking about this for some weeks. It had been in a very stable range, 65-ish, plus or minus a few for a long time. It moving up here is going to have an impact on the economy.
Okay, interesting. Nick, any final word from you? I personally don't believe that the Reserve Bank is going to have a good, hard look at themselves and change their strategy and policy. I think you're dreaming. And I normally never say that about your prognostications. But
No,
if you expect the Reserve Bank to change, then I think you've got Buckley's.
I don't think they're going to change, Chris. I'm always talking conditionally on the basis that they should. However, I hope the things that we've said today and Rennie's view that it's going to be a long term part, most of this year before we see the next adjustment to monetary policy. But I hope that's right. I think all I would ask for is that they consider the broader data and look at a steady, considered framework for monetary policy instead of if you honestly believe the economy is running hot and driving CPI, there didn't seem to even be a recognition that we've moved to official, proper full basket monthly CPI analysis as opposed to quarterly. There needed to be that in the consideration. I would have thought that holding rates today while retaining a hawkish bias would have preserved optionality, allowed time to, let's see where the dollar goes. And then, if the RBA has to start selling the Aussie to get the FX rate down, they're going to look even more foolish. So anyway, we'll see what happens. I think I'm hoping we're one and done, but I don't think they should be dropping rates tomorrow either. Okay, well, we will wait and see. Gentlemen, as always, thank you very much for your expertise and your time. You've absolutely got it right over the last 12 months, and I expect you'll probably have it right and your finger on the pulse over the next 12 as well. We look forward to speaking to you.
Thank
you,
Chris.